thank you for joining us and actually being a part of this amazing series as we reach number 4 of this exciting adventure. I'm Himangi. I'm from the team at Sharesight. I believe you already know me, and if you don't, there's me introducing myself again. If you're not familiar with Sharesight, well, you should be by now, but if you're not, we're Australia's #1 portfolio tracker. We help you check your investments by helping you keep them in one place with award-winning performance, dividend tracking, and tax reporting. I'm here tonight with Vince, reporting live from Life Sherpa's really cool Sydney HQ. It's always a pleasure to introduce you, Vince. Well, it's been a beautiful day outside, and Vince is here to help us end our day on a very beautiful, insightful, informational note. Just a little bit of refresher if you don't know Vince, which is also impossible because Vince is the CEO of Life Sherpa, and he's also one of Australia's top 50 financial advisors. He's also an author of best-selling books, and I think a lot of our attendees got to enjoy a really cool discount at the end of the last webinar. He's hoping that the discount is available again after this one ends. A warm welcome to everyone again. Today's topic is thematic investing. I think it's been quite informative with the last 3 webinars, which are now available to watch on Sharesight's YouTube channel. We learned about optimizing your portfolio right from growth assets to defensive assets, and now I'm hoping that all of this information has just sort of enabled us to take all this complex investment data and trends and learn how to simplify them, or at least for a beginner investor like me to sort of understand these trends and tackle the big mammoth that is the market and approach it in a very positive way in which I can actually learn things and implement them with the help of your guidance, Vince. This webinar is being recorded and will be available for you to watch on Sharesight's YouTube channel afterwards, so make sure you hit the bell icon so that you get notified when this webinar is published live. Without spending too much time, I'll actually hand it over to you, Vince, to start today's session.
Cool, thanks Himangi, that's a great introduction, and tonight we are going beyond the core. We've got a subtitle of Trends, Themes and Tips. So this is about adding some flavour and potentially some engagement to your portfolio, and looking at those things that come and go and some stay around. So let's get right into it. So just to recap on how we got here. So in episode 1 of this series, we looked at the 5 Bs of investing. And for those of you who weren't there, the 5 Bs are the 3 defensive Bs, which is bills, bonds and bullion. So that's cash, bonds and gold. And then on the growth side, we have bricks and businesses. So bricks is real estate and infrastructure, and businesses are shares. And the point about asset allocation is how you allocate to each of those, and within each of those is what drives your return, much more so than individual stock selection. In episode 2, we came back and did a deep dive on growth assets. So we looked at those bricks and businesses and how you might invest in those, and looked at some select ETFs. In episode 3, we focus on the defensive assets, and this one actually had the lowest attendance of the 3 so far, which I guess is a sign of the bull market we've all lived through in the last 15 years or so, and bonds got a little bit out of fashion, but there's certainly always a place for those in most portfolios. And tonight we are focusing on going beyond the core to look at a strategy called core and satellite, where we take the core of a diverse broad market allocation and look to supplement it with concentrated bets in one form or another. So looking at that in pictures, I think of the core as being your fortress. So that's where the vast bulk of your investing should be, focused on fairly broad indexes, supplemented by active managers in sectors where they add value. Certainly, small cap value, emerging markets. They're the sort of areas where there's a lot of evidence that active managers can add value. But beyond that, where there is no evidence that that's consistently true, and that's where we look to stick to broad market indexes. And so if that's the core, then the satellites revolving around that are smaller bets on more concentrated things. So that might include crypto, it might include private credit or private equity, it might include structured products or thematic funds. And we are going to focus a bit more on the thematic funds tonight. There's certainly a lot of ETF products embracing this method of investing. And as a supplement to your core, that's something that people should consider. How much core, how much satellite? That's up to you. Some of my satellite is my TAB account. So when I want to have fun investing, I go to the TAB, and that's money that I'm quite happy to take the moonshots with. So put it on that 100 to 1 roughy in race 4, and sometimes you win. And when you win big. So that's part of the story. But of course, as all gambling ads say, you win some, you lose some, you lose more, but with your head, not over it. So let's focus on that I'll keep that in mind as we go through. So starting with the concept of trends and themes, the key thing here is to know when it's a genuine trend and when it's a fad or a fashion. And that's a fairly difficult task to get right consistently. Some of these serious, genuine trends don't become obvious for some time. Sometimes they're as clear as day, but you've got to decide how you're going to invest in that thing. And that can be a big challenge, and we look at that as we go through. But the concept here is that you need to be able to differentiate between fashion or fad and a genuine trend, or in order to identify a investment-worthy theme. And one way is to try and distinguish between a trend and a cycle. So in markets, cycles occur frequently. They tend to mean revert. That is, you might find that growth assets are up this year, value assets are up next year. Big companies do particularly well this year, tech does well this year, banking does well in other years, resources do well. So these tend to be cyclical. They tend to be reflected in valuations and volatility, and they're often interconnected with interest rates and currency movements. They tend to be shorter cycles, and they do tend to revert back to the underlying mean. A genuine trend, on the other hand, is a one-off, significant step change in the way the market behaves or where returns come from. And they tend to be driven by technology, demographics, and consumer behavior. And certainly when you look at the last one, the internet in the mid-90s to late 90s was a technology theme or trend, but it didn't really evolve into genuine consumer behavior until the iPhone hit the market almost a decade later. So sometimes it's really hard to pick the inflection point here. And that's the challenge we need to look at. But today, I think most people would accept that there are a handful of mega trends, that these are serious trends that are changing the way we live, changing the way we spend, changing the way we entertain ourselves. And the big ones that I look at are technology. So, the way we deal with technology, how technology dealt with the work from home thing during COVID. What is things like the metaverse, the blockchain, quantum computing, what do all of these things mean for the future of investing and the future of our portfolios? People and demographics, we're living in a world where population growth is starting to slow. The population of the world has more or less doubled since I was at high school, and it's arguably going to peak at 11 billion and then start declining as birth rates decline around the world, as more economies become developing economies. That means we're going to have an older population, we're going to have a longer lived population. What does that mean for things like healthcare, aged care? What does it mean for taxes as fewer workers are supporting more older people? What does it mean for retirement savings markets? So all of those things are serious trends that mean something and may very well create investment opportunities. And the climate, I think, is the third one that is on everyone's lips. We've gone from the 1970s, when there was a new ice age approaching. We were running out of agricultural commodities, we were running out of oil. Since then, obviously massive changes in agricultural technology. We've been finding oil faster than we've been using it for much of those 40 years. But the consequence of that is, carbon dioxide build-up in the environment. What does that mean for climate change? And what is the technology that's going to help us mitigate or manage or prevent the climate change? All of these create investment opportunities. They create threats and opportunities for existing companies. And the challenge is, how do we take advantage of that to deliver better or higher returns in our portfolios? So when it comes to a trend or a theme, it's important to work out where in that theme you want to invest. So having identified what theme you want to invest in, now how do you back that in terms of portfolio and security selection? And it is important to pick a niche. The wider you go, the closer you look like a broader equity index, and therefore you probably shouldn't be paying theme-like prices in terms of investment management fees for what will become a broader index market. So choosing your niche is pretty critical. An example, just to look at what that might look like, is if you take the, within the technology and the climate theme, or trends rather, you might look at electric vehicles. So electric vehicles, changing the way we drive, changing the way we buy cars, changing the way we power those cars. And there's sort of four sectors you might look at if you wanted to invest in the electric vehicle theme. You could look at the upstream side, all of the minerals and commodities that are needed to build these things. So things like lithium and cobalt for the batteries, things like copper to build a car, and the dynamics of many of those metal markets are changing. So you could look at investing in a lithium miner, you could look at investing in a rare earth processing company, you could look at buying the commodity itself, all of those are ways of tapping into the upstream part of the electric vehicle theme. You could look at the middle of the stream. You could look at battery manufacturers, and there's certainly a few very large players in China and in Korea. And so you might want to invest in companies that are making the batteries themselves, or you could look at companies that are producing the anodes and cathodes that go into these things. You could move downstream and look at a vehicle manufacturer. So you could be investing in Tesla. You could be investing in BYD. You obviously got to back a brand. Could you, for example, back Volkswagen Group or Mercedes as a legacy auto manufacturer that's tipped to or able to make the transition? Or do you short legacy manufacturers on the basis that they may not survive? They're all themes around the vehicle investing. And then probably more around, well, what does electric vehicle mean for the whole mobility sector? All these companies with e-bikes and e-scooters, companies leasing vehicles to Uber drivers. There's a whole bunch of ways that you could invest in the mobility sector. So the theme being climate and technology, the element or the trend being climate technology, the theme being electric vehicles, and now where in that ecosystem do you want to invest? You have to pick your weapon for these battles. And that leads to what I call the Tesla problem. And so our traditional way of getting low-cost access to global markets is to invest in broad market indexes. But many of these high-growth companies don't get included in these indexes until they're potentially already delivered much of their growth. So looking at this chart, that Tesla delivered most of its growth before it was included in the S&P 500 in December 2020, and in fact has gone backwards since its inclusion in the index. So the money in Tesla was made before it was included in the index, and depending on which broad market you're investing in, if you're in an S&P 500, which is IVV, for example, there you've got a reasonably substantial exposure to Tesla. Many ESG funds filter out Tesla, mostly because of its governance and its labor practices. So you may or may not get Tesla in a broad market index, and it delivered most of its excess returns before it joined the index. So what's the challenge? You could certainly invest in individual companies, and here I use the example of Cisco, or the Cisco conundrum. And this is going back to the dot-com boom in the late 90s. So most people would have accepted in the late 90s that the internet was going to change much of how we live, work and play. But the World Wide Web was launched in 1989. The real growth didn't really happen till a decade later. And in that period, we had the big names were people like Pets.com, Webvan as an online grocer, Alta Vista as a search engine, Global Crossing as the pipes and wires that carried this traffic, AOL, which was the dominant email player in that period. Very few of those still exist. Netscape was the dominant browser. Where is it today? So you had to choose a a vehicle to invest in, having come to the conclusion that the internet was a trend that you wanted to back. And many people would have backed Cisco as the tool of choice here, that it was the company that built all of the routers and the modems and the network equipment that powered the growth of the internet. And it was a massive performer in that period leading up to 2000. It, like most players in the market in 2000, collapsed. So you can see it falling off a cliff. Amazon fell 80% that year, or 86%, I think, peak to trough. And since then, Cisco has bubbled along, never really regaining its 99 peak, despite the changes. We've had Google dominating search, we've had Facebook come to the market, we had the Zoom boom during COVID. The Apple iPhone clearly changed the game, but didn't do very much for Cisco's share price. AWS, the whole cloud computing piece came along, and really Cisco's still a substantial player in the networking market, but certainly looking around this office, we don't have any Cisco kit, but it's very much a telco provider, and it still hasn't got back to its 99 peak. If you'd picked Amazon as your play in the pre-dot-com boom, it listed, I think, at about $18, got to I can't remember what its peak was, but it fell about 86% in that 2000 period, and took a long time to recover. But today you'd be 10x, 20x what you were then. So that would have been a winning bet, although it showed some very rough times in the meantime. Cisco, on the other hand, depending on when you bought in, hasn't really done more than the market as a whole. So choosing your weapon is the key thing here. The alternative to picking individual stocks is to try and pick a theme fund, and which removes some of that idiosyncratic risk of choosing individual companies. And looking at, and the ETF market has made this very easy and convenient to deliver. So as an investor, I'm much less concerned about the size of the ETF I'm investing in compared to the risk to investor of investing in a managed fund that might be that small. And so, in the technology space, we've got metaverse funds, we've got robots, we've got games, we've got esports, we've got cloud computing, we've got robots. Lots of choice there. Lots of growth companies. Similarly, in the climate space, we've got solar funds, we've got climate innovation, we've got carbon trading, materials, you've got battery materials, we've got green metals, we've got all sorts of things. And of course, the food places. One of the challenges with thematic funds is they tend to proliferate when the trend is well underway. So you may very well have missed the boat by the time a large number of funds come along. And certainly if we go back to the dot-com boom, the number of technology funds launched in 99 was staggering, and few of them remained 2 or 3 years later. In the 80s, there was no end of Japanese funds, and 5 years later, there was very few. So you've really got to know what you're picking. And the things about these funds is that they are concentrated bets, in a very small slice of the stock market. Now that's both a positive and a negative. Obviously, concentration gives you greater opportunities to do something different to the market. But not only is it a small slice, is that they tend to be growth stocks, which means you're generally paying a high price to earnings multiple because the market believes that next year's E will be bigger than this year's E and the year after will be better. And so that over time, you'd expect that P to come back to some sort of market normal. But that's fine as long as the earnings growth does actually turn up. But sometimes these stocks get priced for perfection. So that's something you're taking a lot of price risk. Now, clearly, return comes with risk, and you need to take risk to get returns. So that's not something to shy away from, but it is something to understand. These thematic funds play a very important role in satisfying our human instincts. So as humans, we have a strong need for stories, which means that they play to our psychology. They create a very attractive marketing message. So as a business development manager for a fund manager, it gives you a new story to tell to the marketplace. It gives you a new product to launch and gives you a story to sell. And humans, we really like to buy into stories, which creates engagement. And that then gives us the desire to do more with our money. So engagement is an important part of investing because that's what helps you invest more. And then the challenge, of course, is timing. And by the time many of these funds get launched, the trend is usually well entrained. And this magnifies that impact of investor behavior, where investors tend to pile in when price is moving up and pull out when price is moving down. And that's exactly the opposite of what you actually want to do in practice. So that's a sign of caution. And where this plays out is in the return that investors earn. So Morningstar research went back and said that the average thematic fund over the last decade or so returned 7% per annum. But the average dollar invested in them delivered 2%. So that means that investor behavior around this buy high, sell low meant that investors gave up 5% of the fund return. That is, more of the money was invested as the trend got well established. And so the later investors made less. So that 5% is a huge difference. And we'll see that when we come and look at some of the big wealth destroying funds later on. But before we move on, I think it's worth listening to what the great Jack Bogle had to say about thematic funds. And Jack, as you probably know, was the founder of Vanguard and one of those guys who's probably done more for retail investors than most people in the sector, and certainly has played a big role in driving down the cost of investing for retail investors. He was a reluctant convert to ETFs from the traditional managed funds, but he has something here to say about thematic funds in general. So let's listen to a couple of minutes of what Jack told Forbes, I think, probably more than 10 years ago. But the whole interview is interesting, but this little snippet I think is worth listening to at this point. So we'll go to the video and then we'll come back and Hamangi will start showing how we might use Sharesight to help with the analysis of these investments. So Paolo, if you could roll VT.
So fine, and fine for any broad market index fund, in which I would include the total bond market with some limitations, the total U.S. stock market, the S&P 500, international, and even if you want to put a little chunk into emerging market funds, all total market funds. So the idea of investing with the fruits and nuts, it's just, we had, when these funds started, somebody brought out, I don't think this is much of a name, by the way, a fund called Emerging Cancer ETF. And first of all, it should have been curing emergency cancer or something. It sounded like they were hoping everybody would get emerging cancer. And I criticized that particularly in an article I wrote about ETFs in the Wall Street Journal. And the guy who started it wrote me I thought a kind of plaintive letter. And he said, look, I deserve the same chance to try my ideas as you deserve when you started the first index fund. Well, is there a difference between selling quality and selling junk in your first idea? So I guess I gave him a nice answer. Go for it, man. Emerging cancer is long gone. But have things changed? No. Now we have a cloud computing ETF.
Now, I guess when you get to Jack's age, and I have quite a few years to go, you get to play the grumpy old man of the market a little bit. But there is a fair bit of truth in that cynicism that, I think it is important to understand why you're doing it and to preserve your fortress while you're doing it. But let's now just look at some tools that Sharesight can help with making the most of your thematic investment. Amangi.
Thanks, Vince. Well, obviously, as I mentioned, Sharesight helps you track your portfolio, but I'm also here to actually show you how to sort of implement everything that we're learning here with Vince into your day-to-day portfolio tracking so that you're always on top of your investments. So something to do with thematics, right? We want to understand and diversify our portfolio by adding thematic investments into our holdings. I think what the best way that Sharesight can help you with this is a really swanky labels feature, where you can actually go up to your portfolio settings and add labels to every holding that you have. Here you can see in my sample portfolio, I have some thematics, some stocks. So the colored dots represent each of the labels that I've created. So I've got some climate focused stocks in there. I've got food stocks. I've got some tech sector stocks. And what I really want to now understand after adding these labels is just zoom into the performance of these. What I'll do is head up to reports, and the tool that helps here is the performance tool, which sort of gives me, like I said, a zoomed in view of the performance of each of these labels. So I'll run my performance report and I can choose a certain date range. Let's take the current financial year for my holdings. I filter it by labels. So you think, let's compare climate, food, some tech, and let's do materials as well. So that once I click on save and I run this report, I can actually get a good snapshot of the performance of my holdings. So as you can see, there's a bit of red, there's a bit of green. It's, in my opinion, this is the freshest tracking that you can get. You can get a good snapshot of exactly how your holdings have been performing. You can also change the date range, but I prefer to see just the current financial year only because we're.
This is quite an interesting little chart. So, looking at two funds that you might think would be quite similar, being the Metaverse MTAV, which is the BetaShares Metaverse Fund, and Game, which is the esports gaming fund. Both, I suspect, contain a fair bit of NVIDIA, but on this chart, it's showing us that the Metaverse funds fund has done positive. And the Game fund has gone negative. So that's again another good example of diversification in action.
And again, this will just tell you about each holding that you have now. My colored labels are there, they're visible. But I don't know if we remember last time we also touched the concept of groupings in your portfolio on Sharesight. With the same concept in mind, let's go give ourselves a little refresher on what groupings are. So once I have a good idea of a zoomed in view of my performance, I want to understand the performance attribution of each of my holdings. So what I'll do is I'll go to the contribution analysis report. And if I click on run, I'll take the same date range so I can compare it better. Let's go to current financial year. And now I have my grouping that is already set in. So I click on grouping. So again, we have market, currency, do not group, and my grouping. Just a little refresher, you can actually set your own custom groups. So I have my growth portfolio. That was something we covered in the second episode of the series. And we have your alternatives. Then you have your defensive, which we spoke about last time. And we have our thematics, which I've made a group here. So what I want to actually achieve out of this grouping is I want to see how each of these groups is performing. Sorry, I went back to my home screen there. Let's run my contribution report again. Now, this report comes in very handy if I do you see that? That's my snapshot of what percentage contribution to my entire portfolio is based on my groups. So you can see growth here, thematics here, which have actually gone quite red. My alternatives, defensive, and I have some other holdings as well in NDQ, as well as, yeah, so that's my thematics right there. So I can probably see my contribution.
Yeah. So if you scroll down to alternatives, this is a really good example here. So in my alternatives, or in among alternatives, she's got an allocation to gold. So if you scroll back up to the chart, you'll see that the alternatives did particularly well, even though some of the commodities like lithium might be in the thematic. So
so that's my thematic.
Yeah, so there's probably some allocation to hydrogen and lithium in the thematics, but other commodities, in this case gold, have gone in the opposite direction. So again, diversification at work.
Yep. So just a bit helpful information for you to just make sure you know at all times what holding is actually contributing positively, negatively to your portfolio's performance, and give you a better understanding of your own investment journey. You get to play around. You get to actually understand with these various reports how real time your holdings are performing. Again, we can probably touch a concept like we can touch another report probably once you're finished towards the end. We can look at the exposure. But a helpful bit is that this contribution report is currently available to investor, expert, and Sharesight professional plans, whereas the performance report is available to all 4 plans that we offer at Sharesight.
Cool. Right, so we get back to the presentation, and we can come back and have a look at this when we deal with some of the questions that are coming in on the chat line. So moving back to our presentation slides, we'll say goodbye to Jack. And so, despite Jack's cynicism there are ways to tilt the odds in your favour, which is really what investing is about. Charlie Ellis wrote a book called The Loser's Game, which sounds like an odd way of describing investing. But the point he was trying to make is that amateur tennis, which he described as a loser's game, was really around that the winner was the person who made the least errors. Whereas in the professional game, it is about the positive skill of the winner. So investing is very much a loser's game, that much of the secret to success is about avoiding errors. I think Warren Buffett might have called his number one, don't lose money. Whilst you can't invest and take risk without ever having a loss, the key thing is to make sure that you're capturing the return that the market's delivering. None of us know what the market's going to do tomorrow, and none of us control what the market's going to do. But the secret to successful investing is to make sure that the return of the market ends up being your return. So tilting the odds in your favour is the key to winning the loser's game. And when it comes to thematics, I think there are sort of 3 key points I would make about how you do this. So the first one is to have conviction based on evidence, and that we should hold strong views but hold them loosely. So when the evidence changes, your views and position might change, and you need to know when you are wrong and act quickly and decisively. So you need to be ready to kill your darlings and cut your losses, and to know when to let the winners run. So evidence, and change your mind when the evidence changes. We as humans are notorious for what's called a sunk cost fallacy, that we put all this money into some idea, and we believe that eventually it will come good. You've got to know, has your rationale for taking this position changed? Would you take this position today? And if the rationale is no longer true, then you should be exiting the position. So evidence, conviction, know when to change your mind. Know the risks, that you are taking a different set of risks than buying a broad market fund or index. And that can come with excess returns, but you need to understand what these risks are. And you need to be focusing on the longer term. So is this a long-term trend, or is that a right now fad? And that's the key to it. And the next question is, well, where are you going to get your tips or your information? There is an old saying which I think was originally attributed to Joseph Kennedy, who's JFK's father, who in 1929 is reputed to have said that when his shoeshine boy started to give him stock tips, he knew it was time to go. And Joseph Kennedy did extremely well in 1929. He did get out before the big crash, and that's largely what's accounted for much of the Kennedy family wealth. I certainly experienced this in the late 90s during the dot-com boom, when every cab driver in town was handing out stock tips, and it certainly felt very wrong. I'm not sure I acted on it in time, but it was certainly a lesson. My dad used to say that it's no wonder the government can't do a job, because everyone who knows how to run the country is either cutting hair or driving cabs. So, watch where you're getting your tips. If you've got information that is genuinely unknown to the market, depending on how you get it, it could be insider trading and it could be illegal. So, if you're spending time on Hot Copper or Reddit or even Facebook, and you're using that as your source of tips, be aware of the motivation of the poster, particularly on Hot Copper. There's a there's a concept called pump and dump, where someone buys a holding in a relatively illiquid stock, pumps it up on various forums, and a small amount of buying is enough to push the price up, and then when the price starts to move, they sell out. It's to a large extent illegal, but it goes on, so be aware of it. And Hot Copper is a cesspit of this sort of thing, so be careful where you get your information. And remember that great ideas and great companies only make great investments at the right price. So you can have the best idea in the world, but are you buying it at the right price? And to know what the right price is, you need to ask yourself, what do I know that the market doesn't know? Markets are, for the most part, efficient, which means that the price today incorporates all of the information known about this stock, and the price will change when that information changes. That doesn't mean that the price is always right, but it means that the information is transmitted very quickly into the price. So you need to know, am I the only person with this idea? And what do I know that the market doesn't? And of course, betting on a theme or a trend involves getting two bets right. You need to bet on knowing that you're entering at the right time and at the right price, and you need to know when to leave. So that is a difficult trick to pull off reliably. Now that's not to say that you can't make money doing it. People do. But it is not for the faint-hearted, and it's not an easy trick to pull off. And this is a minefield. There is a lot of wealth being destroyed by following some of these themes. Morningstar did a recent piece of work on the 15 funds that destroyed most wealth over the past decade. And when you look at the 15, most of them fall into three broad categories. Technology is the biggest, and Cathy Wood, the founder of ARK Invest, is responsible for two of the biggest, being ARK-K, the innovation fund, and ARK-G, the genomic innovation fund. Together, they've destroyed $11 billion of wealth between them over the last decade. And when you throw in the other ARK Invest funds, you can add another $3 billion to that target, or that toll. And just to put that in perspective, $14 billion is about half of the average annual advice fee paid to all advisors in the US. So there's $35 billion of fees paid to advisors in the US. And so if you can simply avoid toasting 14 billion, then 30 billion in fees might actually be money well spent. The other area where people have come a cropper and destroyed lots of wealth is by betting against what's been one of the strongest bull markets in history. Like the last 15 years, certainly the last 14 years in markets have been extraordinarily strong in a period when we had relatively low inflation and very cheap, easy money. And so the three of the 15 funds that destroyed lots of wealth was funds that were betting against the market. So you've got ones that were betting against volatility, and ones that were generally geared short funds, serious punts. And the other one is a couple of regional tilts. You're certainly betting on China, and Chinese technology in particular has been a poor result for many investors. On the bull market story, I don't know how many times over the last decade or so people have gone, this bull has got to end. There's too much easy money. The Fed's going to start hiking. And now it's time to short the market. But that's a difficult trick to pull off. So between these funds, they have destroyed a lot of value. So if we look at, and I just want to focus on good old Kathy. I love a Kathy webinar. She makes the most outrageous statements, usually around the Tesla share price or the price of Bitcoin, and she does it so conveniently without any sense of irony about the number of times that she's been wrong in the past. And she's built a massive business, and she's worth $250 million, but investors in her funds have lost $14 billion. And so that's a story of how investment managers can make money when their investors don't. And the funds, if you look at the return from inception to today, and you go, well, actually, maybe that's not a bad result, but the fact that most of the money piled in the period when these funds were really running. And, we had very robust discussions at our investment committee here at Life Sherpa. One of the members of the committee was very keen on getting RK onto the approved product list, and ran a very convincing presentation. But too much time in Kathy webinars certainly convinced us that this was not a good fund to add for our members. So, as Charlie Ellis says, it's avoiding the unforced errors that is the key to successful investing. And so when it comes to theme investing, I think Dirty Harry has the question for you.
Mm-hmm.
Will do you? So that's the story of tips, themes, and trends. So now we can move to questions. One of the, I can see on the chat here that one of the big questions that we see from our members, and obviously our audience tonight, talks about the overlap between different funds. So many people get concerned that, if I'm buying, if I'm invested in a broad-based US fund, whether that's an NDQ or a VTS, I'm holding quite a few technology shares. So if I'm then go and buy MTAV because I want to invest in the metaverse, am I just doubling up? So I think there's a tool in Sharesight that would be, can you show us that, Hamangi?
Yeah, for sure.
So have a look at the portfolio that I created earlier, very unimaginably called Vince's Portfolio B.
Sample portfolio.
It is not a real portfolio. It's here to be able to demonstrate the point around this overlap.
So we've got two holdings in MTAV, one in MTAV and one in NASDAQ, along with some individuals in Alphabet and NVIDIA. So I think the report that you were sort of talking about is the exposure that will give me a snapshot of exposure in terms of my underlying and direct holdings if there's an overlap. So let's just go by default on Do Not Group. Are you able to see that? All right. If I filter it by percentage, there you go. So
the question on the chat was really about how do I deal with overlap? And so this portfolio is designed to show a holding of vanilla NASDAQ NDQ, so that's the NDQ 100, which is very much a tech-dominated index. And the investor here happens to work for Google, so they also have some employee shares in Google, and being in tech, they feel they understand the whole market, so they want to look at the metaverse fund. And so by adding the metaverse fund to that, they were concerned, as is our question tonight, about, well, am I just doubling up? And so this report shows me that, sorry, I have to put my glasses on. So it shows me that that within this, I'm holding Google directly, and I'm also holding it as part of the NASDAQ. But with the metaverse one, so NVIDIA is the next big holding here. And so I've got that as part of the NASDAQ. I've got it as part of the metaverse, and I've got a direct holding.
Yeah.
So the question is, am I just doubling up here? But the point about thematic investing is it's as much about tilting your portfolio rather than necessarily trying to take a clean solo investment. So by adding more Google or more NVIDIA and more Facebook to the portfolio, they're tilting their holdings towards stocks that are going to benefit from the metaverse. It's not saying I'm going to take everything and throw it into the metaverse. It's simply buying more of those individual components and tilting my portfolio towards the metaverse theme or trend. And that's really the place of, that's how this whole satellite and core works, that your core in this case might very well include a NASDAQ ETF to make part of your US exposure. So the US is 70% of global equity markets today. And so you will have a large chunk of your core in the US. Now that could be built up from a total market index like a VTI. It could be made up of NDQ or S&P or some combination of both. And then you might bolt on as part of your satellite a metaverse allocation, which simply tilts it towards that route. And this sort of report allows you to very quickly see that, you know, you've got, in this case, what percentage of your portfolio is in each of these
what
stocks.
Percentage.
So it is really useful in looking underneath an ETF and say, well, what is this ETF invested in? I think it probably gives you the top 50 holdings.
Yeah, top 50 holdings.
Which for most of these thematic investments will be a very large chunk of the underlying value that, some of them have as few as 30 holdings. So that will give you a really good picture of how it works on its own and how it works in connection with your core holdings. And it's that combination that delivers the value. So hopefully that answers your question there.
We have one.
Do we have time for one more?
Yeah, we have one.
I know we've just hit the 1 hour mark.
Yeah, we'll just get this one done. So I think this is pertaining to a previous point that you said about exiting the market. So someone's asked us, can you give me an example if you've ever left a market based on the information available for you? Are there any telltale signs that indicate that you should exit or stay in the market? Are there any signs that you should look for?
Yeah, that's a great question, and I'm trying to remember who said it. One of the major fund managers said that more money was lost in preparing for downturns than in the downturn itself. Lynch, Peter Lynch, was the man who said that. So this is a really, really tough exercise to pull off. That there's a bunch of research that what does it look like if I miss the 10 worst days in the market? And the answer is you look like an absolute legend, because it does a huge amount of, if you take out the 10 worst days, it massively increases your return. The same works in reverse, that if you miss the top 10 days, your return declines massively. Now, the problem is the best days and the worst days often come next to each other. So, what we find in periods of great volatility is you get these big swings. So the big days often clump together. So it is quite difficult to exit completely, also exit and get back in. And often what you find is people exit and wait too late to getting back in. So they actually end up giving up most of the recovery. So in theory, it's a great idea. There are some tools you can look at. If you're a trader, it's certainly possible to look at some moving averages. There are lots of signals that might indicate that this is a trade. But if you're a long-term holder, popping in and out is a really difficult trick to pull off. And many of those sort of longer-term indexes, people talk about PE multiples, people talk about cyclically adjusted PE multiples, people talk about all-time highs. In a market that's rising, and markets do in general rise over time, 75% of the years they go up. As Nick Murray says, it's the declines are temporary, the advances are inevitable, and much of the return comes from being there. If you're a trader and this is what you do day in, day out, then absolutely coming and going is a way of generating returns. But that's a difficult trick to pull off reliably for a long-term investor. That getting invested, staying invested, and investing more is the key to success.
So
is that's we don't have time for any more. Well, that's disappointing. I enjoy the Q&A days, but
4 minutes over.
We're already 3 minutes over. So with that, I think we should wrap it up for tonight. Just a heads up that the next episode 5, the grand finale, is where we pull all of this together and look at how you build a real life portfolio. So we look at how these funds interact with each other to deliver a portfolio that will maximize your return for any given level of risk. So we'll see you again in a month's time.
Yep. And now's probably a good time if you wanted to catch up on previous episodes on Sharesight's YouTube channel. We'll obviously be sending you an email with the recording if you've registered already. And with that, the fourth session comes to an end. Remember that Sharesight is available to every paid customer of Life Sherpa included in their package. So you get all the features that you saw us using today, including the report that we showed you towards the end. The exposure report is all available if you're already a paying customer of Life Sherpa. Even all the more reason for you to upgrade your accounts if you're already with Life Sherpa. Stay tuned for the webinar recording, and we'll see you in a month's time at the next and the last investing masterclass. Thank you for your time, Vince, and we'll see you next time. Good night.
I've been Vince, and you've been great. Good night.